Presentation. Let's say something about presentation. Presentation. Now, the International Accounting Standard number 7 allows two methods for presenting cash flows. Understand? There are two methods for presenting cash flows from operating activities. We have the direct method Now, the direct method presents cash flows and outflows from operating activities. It does what? It directly presents cash flows and outflows from operating activities. Then you have the indirect method, which starts with the net income. This one starts with the profit before tax, or the net income. All right, and then adjust for non-cash items and changes in working capital to arrive at the net cash provided by operating activities. So the presentation, the only difference within these two methods is just on operating activities. That section for operating activities, but the other section for the two methods is the same. The only difference is on operating activities section. There are two ways to present the operating activities. We can use the direct method or the indirect method. The direct method, the operating activities are presented directly. The method directly presents cash flows and cash outflows from operating activities, but for the indirect method, it is not direct. It starts with the net income and then adjusts for the non-cash items and then changes in working capital in order to arrive at the net cash provided by operating activities. We're going to have an illustration, and in this illustration we're going to use the indirect method. Let's turn to August 2024, question number 4. The following are the financial statements of Precious Limited for the years ended 31st March 2023 and 31st March 2024. So we have the statement of profit or loss for the year ended 31st March 2024. So we have the gross profit and operating expenses. We have other incomes. Then down there we have the net profit after tax. Net profit after tax. Then on the next page we have the statement of financial position for the 2 years 2023 and 2024. Below the statement of financial position, we have additional information. Number 1, Precious Limited purchased investments worth 11.7 million during the year ended 31st March 2024. You see that purchased investments. Number 2, the company sold investments that had cost 13.5 million for 15.3 million during the year. Sold investments. Underline that. Number 3, during the year, new machinery worth 18 million was acquired. Some items of property, plant and equipment that had cost 1.5 million was accumulated depreciation of, with accumulated depreciation of 0.3 million were disposed of for 750,000 shillings. Number 4, included in the operating expenses for the year ended 31st March 2024 is the depreciation charged for the year amounting to 5,550,000. Number 5, the company issued bonds worth 15 million or at face value in exchange for planned assets on 31st March 2024 and repaid 7.5 million of bonds at face value. Number 6, the company issued 2,220,000 ordinary shares at 10 shillings per value during the year. Number 7, the company paid cash dividends of 1.2 million during the year ended 31st March 2024. Required statement of cash flows for the year ended 31st March 2024 in accordance with International Accounting Standard number 7, statement of cash flows. 16 marks. 16 marks. So this is August 2024. Question number 4. You have to prepare the statement of cash flows for the year ended 31st March 2024. You have to first write the heading. The title is Precious Limited. Precious Limited. Statement of cash flows for each period for the year ended 31st March 2024. So we'll have 2 columns, the amounts in thousands. So we're going to begin with cash flow from operating activities. And we're going to use the indirect method. We begin with cash flow from operating activities. Cash flow from operating activities. Then we do the cash flow from investing activities, then cash flow from financing activities, in that order. Now, using the indirect method, we begin with the profit before tax. The profit before tax. What is the profit before tax? The first statement, profit before tax. The net profit before tax is 3 million. Can you see that? You have to begin with the profit before tax. Then we make the adjustments. Profit before tax is 3,450,000. Do you see that? 3,450,000. $3,450,000. That is the profit before tax. Yes, 3,450,000. Then candidates, that profit before tax has to be adjusted for non-cash and non-operating items. You have to make adjustments for non-cash and non-operating items. Because you recall, we are preparing a cash flow statement and we are beginning with the profit before tax. We want to calculate the cash flows from operating activities. We define operating activities as activities, the core activities of the business. The core activities of the business would involve the buying and selling of goods or services. Operating, the operations. When you talk about operations, we are talking about the regular activities. Regular activities will include buying and selling. After buying and selling of goods and services, a company generates profit. That's why we're beginning with profit after tax. The company generated this amount, profit before tax, 3,450,000. I want you to get the understanding. The reason why we begin with the profit before tax. Profit before tax is represents the amount of money that the entity generated from operations. How do you arrive at profit? You take this sales, deduct cost of sales, you get the gross profit. That's what we have here in the information. Look at the statement of profit or loss account. We begin with the gross profit, then expenses, then you have other incomes, then you have gains on sale of investments and so on. You have interest, expenses paid, net profit for before tax. Then you have net profit before tax. Do you see that? Don't just memorize, candidates. Just get the understanding that the activities we are calling operating activities. These operating activities help the company to generate cash. So we have cash from operating activities, buying and selling of goods or services. So the amount for this company is 3,450,000. Included in this 3,450,000, we have non-cash items. And how do you identify the non-cash items? Look at the question. Look at the question. Before the profit before tax. Before the profit before tax, look at the items there. What items do we have? You don't need to struggle much because the information is provided. Now, before profit before tax, we have other incomes, because the statement has the gross profit, then we have the operating expenses. Operating expenses, listen to the language, operating expenses. These are expenses that the business incurred in the process of generating that gross profit of 26.7 million. They are operating expenses, candidates like salaries, like rent, like things like power, water. There are companies that serve even tea in the offices. All right, that is money also under operating expenses and operating expense. So we have other incomes like interest income received. There is gain on sale of investments. Then there is loss on sale of plant. Then we have interest expenses paid. Then there is net profit before tax. So the net profit before tax, we are supposed to check the items that appear before net profit before tax and find out and identify if there are any non-cash and or non-operating items. Look at the board. Look at the board, please. Profit before tax. Then we have to adjust for non-cash items. That is to mean that part of this profit, there are items that did not involve movement of cash. So what are these non-cash items? Titus says interest expense paid. Titus, look at what you've just written. Interest expense paid. It's a question I asked. Give me an example of a non-cash item. Non-cash item. If interest was paid, then that is a cash item. Is it not? It is a cash item. If it was paid, then it means money flowed from the business to the one who received it. That is a cash item. I want you to isolate, to identify, first of all, a non-cash item. And Titus, of course, you are right. The interest expense it will have to be adjusted, but it's not a non-cash item. Let's do it systematically for the sake of understanding. Give me an example of a non-cash item from the items that are listed there: interest income, gain on sale of investments, loss on sale of land, interest expense, and so on. Gain, correct. Someone says gain on sale of investments. Gain on sale of investments. That is one non-cash item. Gain on sale of investments. How much is it? 1.8 million. 1.8 million. Now, how do we make the adjustment? Are we going to add to the profit, or are we going to deduct to the profit? Because you see, this gain on sale of investment was deducted. John Buddy says deduct. It was initially added because it's a gain. Because gain on sale of investments you add to the profit. And given that it is a non-cash item, it increased this profit by 1.8 million, and therefore we have to remove it. Another one is, which one is it? Loss on sale of plant. Loss on sale of plant. When preparing the income statement, the accountant, how much is it? Loss on sale of plant is 450. Loss on sale of plant was deducted from the profit. It is a non-cash item. There was no money that was actually lost. It was just an entry in the books. So if it was deducted, then we have to add it back. So here we leave it as a positive. We add it. So these are the two non-cash items. Then from the other, we need to identify the non-operating items in the income statement. Non-operating items. Which are the non-operating items? Non-operating items. Titus said singled out interest expense. Interest expense is not an operating activity. Interest expense paid is not an operating activity. Do you understand, candidates? Interest expense. That interest, is it interest expense? Yes. The interest expense, how much is it? It's 3,400,000 and, am I right? 3,450,000. Interest expense, let me confirm. Interest expense from the statement of profit and loss, interest expense, you see interest expense was deducted 3,450. It was deducted 3,450 interest expense. Interest expense 3,450. It was deducted because it's an expense, so we add it back. Then we also have the interest income received. Interest income received. What is the amount? Interest income received, the amount is 900. When the interest income received, when it was received, the accountant added it. It was added to the profit. So, and therefore we have to remove it because it is not an operating activity. So we have to deduct it. Now, do we have any other adjustment, non-cash and non-operating item from the information? Look at the statement again, the income statement. We have interest income received, gain on sale. We've recorded the loss on sale of plant, and then interest expense paid. We have adjusted all those items. Then candidates, give me the adjusted profit before tax. Give me this total. Add it there. What is the amount? The adjustments. Give me the adjustments. Do you have any other? This question we didn't have depreciation. Depreciation is also a non-cash item. Do you have depreciation? Depreciation. Any information on depreciation? George, where are you? Are you sleeping? Depreciation. Now, to calculate depreciation, we need to check the additional information. Do you have any information on depreciation? What note is it? What note is that? Note number 4. Included in the operating expenses for the year ended 31st March 2024 in the depreciation is the depreciation charge for the year amounting to 5,550,000. That is depreciation. Depreciation was deducted from this amount. To have deducted to get that amount. Part of the operating expenses, we have depreciation. Depreciation is a non-cash item. It is a non-cash item. When we provide for depreciation, there is no money that is paid. It is an expense, but does not involve the movement of cash. That's why we are calling it a non-cash item. And since it was deducted from the gross profit to get this net profit, we have to add it back. 5,550,000. So that's it. Give me the adjustment. Is it a positive or is it a negative? How much is it? So we'll have here cash flow before working capital adjustments. What is the total tally? 6750. So this is 6750. Is it positive or negative? If it's positive, add it to 3450. Whatever you find there is cash flow before working capital adjustments. John says 10, 1200. So that is 10, 1200. $1200. Is that the case? 10,200. 10,200. 10,200. So that is just one component of operating activities. Operating activities involve the cash that is received through buying and selling and all that, but we have to adjust this with the what we call adjustment of non-cash working capital changes. Non-cash working capital changes. Now we move to the balance sheet and analyze the working capital items, the inventories, we have the accounts receivable, accounts payable, working capital, changes in working capital. Look at the balance sheet. Adjustments of non-cash working capital changes. We analyze the current assets, working capital items. The balance sheet, please. Let's turn to the balance sheet. You can see there we have current assets. Do you see that? In 2023, inventories amounted to 16,500. In 2024, the amount is 21,600. Is that an increase or a decrease? Now, for those of you who are attending the cash flow class for the first time, for the benefit, for the sake of those attending the class for the first time, we have to help you with some workings. Working. Number one, we can have a working for that first item in the balance sheet. Inventory. We can have inventory account. Now, we are preparing candidates the statement of cash flows for the year ended at 1st March 2024. And we are given the balance sheets for 2023 and 2024. And these are balance sheets at the end of the accounting period, which ends on 31st March. So we have information for 31st March 2023 and 31st March 2023 and 31st March 2024. So the inventory account, the amounts that appear in 31st March 2023 is a balance brought down in 2024. The balance at the end of the year 2023 is the balance at the beginning of the year 2024. So that balance in the balance sheet, give me the balance sheet please. The balance sheet, look at the balance sheet. What is the amount? The amount accounts receivable. I began with inventory. Let me, it's okay, even inventory. Let's begin with inventory. So the balance brought down is 16,500. So we have it 16,500. That is balance at the beginning. Now the balance at the end, is how much? The balance at the end is 21,500. So we have here at the end, balance carried down 21,600. 21,600. So we balance off that account. So there is a deficit on the debit side. You compare these two. So what's the difference? Unless there is any other information and additional information, candidates, is there any additional information? No. What's the difference? 21,600 minus 16,500. George says 5,100. So we have 5,100 here. So this is what we take to the cash flow statement. So this you can see clearly is an increase. At the beginning, the balance is 16,500. At the end, the balance is 21,600. That tells you there is an increase. There is 16 million at the beginning, then 21.6 million at the end. So there is an increase. Do you see that? Increase in inventory. So that is the first change. Working capital changes. Inventory is a working capital item, a current asset. It has changed. It has increased from 16.5 million to 21.6 million, and the increase is 5.1 million. So there is increase. You write here increase in inventory. Increase in inventory 5.1 million. Are you following, candidates? So when there is an increase of or in inventories, does that represent an inflow or an outflow? When inventories increase, does that tell us that the company spent money on increasing the inventory, or does the increase tell us or indicate to us that the company did not spend money? So is it a positive here? Are we adding to this amount, or are we going to deduct? Title says outflow. Very good. Outflow. So you put it in bracket. But if it was a decrease, if there was the other way, that there was 21.6 at the beginning and 16 at the end, that tells you that there is a decrease. That means that the company sold inventories. The company sold inventories. If there is a decrease, it had more inventory at the beginning and they have reduced at the end, so that would be an inflow. The company received cash. Let's analyze the second item in the balance sheet, working capital changes. What is the second item? What is the second item in the statement of financial position? The second item there is accounts receivable. Accounts receivable. So we open another working, accounts receivable. And then we have the balances. What is the balance at the beginning? Balance at the beginning is 8,250. So we have balance brought down 8250. What is the balance carried down? The balance at the end. The balance at the end. Give me the balance at the end. The balance at the end is 7050. 7050. So at the beginning, the company had debtors 8250. At the end, this amount has reduced. So the difference definitely we are taking to the cash flow. Okay. So that means that there was a reduction of how much? What's the difference? This is a decrease of how much? What's the decrease? 8250 minus 7050. That is 00. 800. Is it 800? 1200. Is it 1200? 1200. So 1200 is right here, decrease in accounts receivable of 1200. The company had debtors 8250. The debtors have reduced to 70. That means the debtors paid 1200. So that is a cash inflow. So it remains a positive. What is the next working capital item? Prepayments. Prepayments. We'll have a working for prepayments number 3. Prepayments account. What is the balance at the beginning? Balance at the beginning. Prepayments. That is the 22. Am I saying the right thing? 1, 2, 3. That is 750. 750. At the end, the balance is prepayments 150. So the difference of 600. This is 600. Has gone down. Prepayments. Take this to the cash flow. This is a decrease. Decrease in prepayments. Decrease in prepayments of 150. Is it a negative or a positive? Deduct. We deduct prepayments. Supposed to be 600. 600. This is 1200. Then 600. Decrease. Do we deduct or we leave it at that? Prepayments. The next item, working capital item, is accounts payable. Give me the accounts payable. Accounts payable, current liability. Give me the next page, please. The liabilities, the current liabilities. Yes, we have the liabilities. Current accounts payable. We have the working number 4. Accounts payable account. What is the balance brought down? Balance brought down, accounts payable. Balance brought down, accounts payable is it 6450? 6450. Balance carried down at the end. Balance carried down at the end. Accounts payable 7500. 7500. So the decrease is on the debit side. What is the decrease? Decrease, please, decrease. This is increase, not decrease. It has increased from 64.50 to 75. This is an increase. $10.50. So it's supposed to be on this side. Increase $10.50. It's an increase. It has increased. So increase in accounts payable. This is increase in accounts payable of $10.50. What does that tell you? At the beginning, there is unpaid liability of $64.50. At the end, it has gone up. What does that represent? Does it represent an inflow or an outflow? When creditors increase, does it represent an inflow or outflow? That is an inflow, because creditors is a source of funds, right? When you have a creditor, that means that you are holding money that you ought to have paid to the creditors, but you've not paid. Instead of paying, it has gone up by $10.50. The company ought to have paid $64.50, but it's not cleared it. It's gone up by $10.50. So that increase is an inflow. It is treated as an inflow. Correct. We have accrued liabilities. Accrued liabilities. Working 5. Accrued liabilities account. What is the balance at the beginning? Accrued liabilities at the beginning $13.50. At the end, what is the balance at the end? The balance at the end, accrued liabilities $1,800. This is an increase. It is an increase. How much? This is this should be 550. Is it 550? 550 increase. Increase in accrued liabilities of 550. Accrued liabilities 450. This is 450. 450. That is an inflow. Inflow. Any other item? Working capital changes. We've analyzed all the current liabilities and current assets apart from cash. We don't analyze cash. So give me the total. Interest expense and the tax expense. We adjust it before we get the net. This is just cash generated from operations, from the operations. So what is the interest expense? Give me the interest expense. Do we have interest expense? Yes, from the the income statement. Less interest expense. Was it 3450? The one we adjusted somewhere here. Yes, 3450. We deduct because it's an interest expense. Then tax paid. How much tax was paid? Tax paid. We need a working for tax paid. Working. What information do you have on tax? Do you have tax payable in the statement? Tax payable. Yes, look at the current liabilities. There is a tax payable of 750 at the beginning and 450 at the end. So we have tax account. There is a balance brought down at the beginning. You see candidates, it's under current liabilities. That means that at the beginning of the year, there was tax outstanding, and paid tax is 750. At the end, the tax unpaid is 450. So at the beginning we have 750, at the end it has gone down. That tells you that there was tax that was paid, the difference. 750 minus 450, that is 300. That is tax paid. The difference is the tax that was paid. So at the beginning 750, at the end it has gone down. That means the company paid 300. You understand? Tax paid 300. Is it 300? Or I picked the wrong figures. This is current liabilities, tax payable. Tax payable 750 and 450. 750 and 450. Then before that, candidates, you can check the, do you have any information on tax in the statement of profit? Look at the statement of profit. Look at the statement of profit. The statement of profit, do you have any information on tax? Yes, there is income tax, candidates, for the year. Just before, after the net profit before tax, do you see that income tax 1050? Income tax 1050 was paid during the year. That is income tax for the year 1050. So we're going to credit the tax payable account with 1050 before we get the balance. So we have income. This is the statement. Let me just say profit and loss 1050. 1050. So this balance is at the end. Is a balance carried down. Balance carried down 450. We still need to check for any other information in the question on tax. We analyze, do we have any other information on tax? Do we have any other information on tax? If there is no any other information on tax, then let's balance off this account and find out if there was any tax that was paid. This is just tax for the year, just calculated, but when it comes to payment, we get the difference. So we have the difference here, money that was paid to the bank. So the bank account is credited, tax account debited. What's the difference? What is the balancing figure? How much tax was paid? Because I can see this side is greater than this side. So that means that there was tax that was paid, actually paid. The 1050 does not necessarily mean that the 1050 for the year was paid. No, according to the profit that was generated, because we know tax is applied the 30% is applied on the net profit. What was to be paid for the year is 1050, but what was actually paid will be the balancing figure. How much is it? 1350. 1350. That is tax paid. Now, when you pay tax, is it an inflow or an outflow? 1350 is an outflow. So we deduct these two items from the cash generated from operations, and that will be the net cash flow from operating activities. How much is it? Net cash flow from operating activities. 36, someone says 3600.